For years, the biggest banks on Wall Street told you crypto was a scam. They called it a Ponzi scheme, a tulip mania for the internet age. Jamie Dimon, CEO of JPMorgan, called Bitcoin a fraud and said it was worthless. He even said he would fire any trader caught buying it. That was then. Today, JPMorgan offers Bitcoin exposure to its wealth management clients. BlackRock, the largest asset manager on earth with over $10 trillion under management, launched a Bitcoin ETF. It became the fastest growing ETF in history. Goldman Sachs, Fidelity, and Morgan Stanley are all in. At the same time, these exact same institutions are quietly loading up on gold at a pace not seen in decades, both gold and crypto simultaneously. So here's the question you should be asking. What do they know that they are not putting in a press release? That is exactly what we are going to find out today.
To understand why they're doing this, you have to understand the problem they're trying to solve. Global debt has crossed $315 trillion. The US alone is carrying over $34 trillion in national debt, and that number is growing by roughly $1 trillion every 100 days. Central banks have spent 15 years printing money, buying bonds, and keeping interest rates artificially low. The result is a financial system deeply, structurally dependent on continued stimulus, where the cure and the disease have become the same thing. The smartest money managers are quietly telling clients that the era of the US dollar as the unquestioned global reserve currency may be entering a long, slow sunset. Not a crash overnight, but a gradual erosion of trust as BRICS nations build alternative payment systems and central banks reduce dollar reserves. They hedge methodically and quietly before the crowd catches on. The hedge they're reaching for comes in two forms, one ancient, one new, gold and Bitcoin. Let's start with gold because the numbers here are staggering and most people have completely missed this story. Central banks around the world have been buying gold at the highest rate in over 55 years. In 2022 and 2023, they purchased more than 1,000 tons of gold per year. China, Russia, Poland, India, Turkey, all quietly accumulating physical gold and reducing their US Treasury holdings at the same time. This is not a coincidence. When a country reduces its dollar reserves and buys gold, it is making a deliberate statement about what it trusts as a long-term store of value outside the reach of US sanctions and outside the SWIFT system. The big institutional players have watched gold hit all-time highs and hold its value through inflation, banking crises, and geopolitical shocks. In an era of currency debasement, that is not a boring bet, that is a survival bet. Now here's where it gets interesting because Bitcoin is doing something gold can't. BlackRock's iShares Bitcoin ETF pulled in over $10 billion in assets in its first 2 months. Let that sink in. $10 billion from institutional investors, pension funds, endowments, registered investment advisors, all piling into an asset that the same institutions called a toy 5 years ago. Why? Because Bitcoin has a property that no other asset on earth has, a hard, mathematically enforced supply cap of 21 million coins. Then there's the halving cycle. Supply shock meets growing institutional demand, and history says that combination does remarkable things to price over an 18 to 24 month horizon. Wall Street understand supply and demand better than anyone. They ran the models. They saw the ETF approval coming. They positioned before the crowd. That's what they always do. And while retail investors are debating whether crypto is real, institutions are quietly accumulating, just like they did with Amazon in 2001, just like they did with Apple in 2003. Here's what buying both gold and crypto at the same time actually tells you. It's not a contradiction, it's a thesis. The thesis is this: we are entering a period where the traditional system, dollar dominance, fiat money, and government bonds as the safe asset is going to be increasingly challenged. And in that environment, you want exposure to anything that sits outside government control and has genuine scarcity. Gold has 5,000 years of track record as the answer to that problem. Bitcoin is the digital native answer for a world that now moves at the speed of the internet, borderless, programmable, and self-custodied. They're complementary hedges against the same underlying risk, the slow erosion of trust in the institutions that manage your money, and the fact that JPMorgan, whose CEO publicly ridiculed Bitcoin, is now offering it to clients because the money flowing into these assets became too large to ignore, because their own clients were demanding it, because the smart money inside those institutions had already decided. So what what do you actually do with this information? 3 things. 1. Stop waiting for permission. Retail investors historically get in after institutions have already positioned. The ETF approval was the signal. The halving was the signal. The central bank gold buying was the signal. But they require you to pay attention to things most people aren't watching. 2. Think like a portfolio manager, not a gambler. Institutions aren't putting 80% of their capital in Bitcoin. They're allocating 1%, 3%, maybe 5% to alternative hard assets as a hedge. Gold for stability, crypto for asymmetric upside. The rest stays in traditional instruments. Gold is volatile in its own right. Bitcoin can drop 60% in a cycle. These are not safe havens in the short term. They're long-term, macro-driven positions. If you can't hold through volatility, you'll buy at the top and sell at the bottom, which is exactly what institutions count on retail to do. This is not financial advice. The biggest banks in the world spent years telling you gold was a relic and crypto was a scam. Then they bought both. There's a lesson in there, and it's not about gold or Bitcoin. It's about who gets to move first, who gets to move second, and which one you're going to be. If this gave you something to think about, hit like and subscribe. I cover exactly this kind of macro financial intelligence every week in plain language with no agenda except helping you see clearly. Drop a comment below. Are you more convinced by gold right now or crypto? I want to know where your head is at. I'll see you in the next one.